let's just get started. Look, obviously, there wasn't a lot of news this week, but it was important news. It was probably the most important news that we could have received, and that was that interest rates are going higher. They're not going down anytime soon. The other tidbit that we received is that interest rates are going up more than we expected, and interest rates are going up in other countries as well because they're following right on our heels. Everybody's suffering from inflation. It's not just us anymore. There are other countries who have inflation for various reasons. We started it, we printed a lot of money, but then there were different imbalances around the world, and in a war and all that other stuff happened about a year or so later, and so the whole world is kind of in trouble right now. So anyway, let's just look real quick at what was going on. So just to remind you, I'm going to ask you this every week: what makes stocks go up and down? Because this is good for our investment challenge or any other investment competition. The reality is this. Here's what makes stocks go up and down. You know what it is? Anybody want to raise their hand? Earnings, cash flows, changes in growth rates, changes in your expectations of those earnings or cash flows. Go up or down. Maybe they're going to go up faster. Maybe they're going to go up not so fast. Maybe they're going to turn negative. And that comes down to economic expectations and changes in interest rates, discount rates, right? So we've got a lot of negatives going on here right now. Earnings are coming in pretty good, but we're getting lower earnings expectations in terms of our growth rates. We're getting higher interest rates, which means the cost of capital is going higher for debt and equity, which means our discount rates for our discounted cash flow models, our dividend discount models, all of those things, we're going to have thanks for requesting remote control of my screen, Alex. Thanks, by the way. We're going to have a whole bunch of things going on that's going to make not only are interest rates going up, but growth rates are coming down. And the two of those together are putting a lot of pressure on things like PE multiples, where we're going to have a situation where PE multiples, well, they were at 22, and they went to 21, then they went to 20, then they went to 19, and they went to 18. And our PE multiples on forward earnings are now around 17 on average for the stocks in the S&P 500. All right, so there were some good earnings this week. We talked about some of them and why they could be good or could be bad. Some of them were really good. Let's look at one real quick.
General Mills shares rose on Wednesday after the company posted a healthy beat on first quarter earnings and elevating full year forecasts. For the first quarter of its 2023 fiscal year, General Mills notched up a 4% jump in net sales to $4.7 billion and a 13% rise in adjusted diluted EPS to $1.11. Analysts had anticipated $1 and $4.72 billion, respectively. Operating profits also rose, notably jumping 8% on an adjusted basis to $1.1 billion. Head to Seeking Alpha to read the full article and get the full in-depth analysis, and while you're there, explore all of our premium features, like our exclusive quant rating, which rates General Mills as a hold.
Well, obviously their hold rating was a bad rating because that stock should have been a strong buy. Let's face it. This was a flavor.
General Mills shares rose on Wednesday after the company.
Thank you. All right, so look. If a company beats its earning expectations and raises its guidance, then our expectations for future earnings are higher, and therefore, thank you for sharing your screen. Ooh la la la. Obviously the beat is here and the raise is here, and look, this stock did really well, and this is a consumer staple stock. This is a food and beverage stock, right? This is not normally considered a growth stock. This is considered a stock that's slow and steady. But sometimes, you guys all know the fable, sometimes the tortoise and the hare, right? Slow and steady wins the race. Right now, we're in a tortoise and the hare situation where semiconductors and software companies are the hare. They go really fast, but right now they're kind of taking a nap. And what's going on? The consumer staples companies are the tortoise, and they're winning the race. And so it's kind of a no-brainer. You look at this chart, and I showed this to you last week, and I told you to use it as a cheat sheet, and I hope all of you did. I'm sure all of you went out and bought Tesla and Apple instead, which is a no-no, and shame on you. You're all very naughty, naughty, naughty. Because this is the simplest thing you can possibly read. Look at the thing that's the most red on the right, and that's the most green on the left. Food went from very low inflation to very high inflation right now, 11.37%. I mean, some things are still higher, but look, it's trending down because this energy went from 41 to 28. But this is still trending higher. Food prices, when you look at the CPI report, are out of control. And you know what that means? It means that food companies are going to earn a lot more money. They're just going to charge you more. If their costs go up, they're going to charge you more. If their costs don't go up, they're going to charge you more anyway. They don't care. They can charge you more, so they're going to charge you more. Anyway, there are other things on here that are similar, and some of them are trending a little bit lower, but are still trending hot, like airlines were negative, and now suddenly hot, positive, 33%. That's down from 37%, but still, it's quite high. So maybe this is another area where we could look. I don't know. Maybe airlines, maybe food, maybe energy, things like that. Dariana, go ahead. Do you have a question?
I'm so sorry to interrupt, but we can hear your Discord notifications in the back, and also someone's saying racial profanities in chat. So I just wanted to bring that to attention. I'm really sorry to cut you off.
No, I completely understand. And you know, I already closed my Discord, but let me just I absolutely close it. I'll just quit it. All right, so Discord's gonna shut up. I know. Look, there's a lot of things going on with team meetings right now and stuff like that. So Discord's blowing up all the time. With the chat, come on, keep it clean, people. All right. Time for adulting. I know adulting is hard, but try your best. All right. So remember what I said last week. This is what I said last week. The macroeconomic news for next week, which is this week, is number one, the Fed's interest rate decision. Number two, the Fed's interest rate decision. And number three, the Fed's interest rate decision. Those are the only things that are important this week. And you know what? They really not only raised interest rates as much or slightly more than expected, but they raised their expectations for future interest rate hikes too. And that was what's most troubling for the market. And that's one of the things that sent the market into a tailspin. So let's see what happened.
A unanimous Fed raises the benchmark rate 75 basis points as anticipated and offers no sign that it is ready to stop tightening. The dot plot shows the median forecast for Fed funds next year, by the end of this year rather, at 4.4%, which suggests about another 125 basis points over the next two meetings, which leaves a 75 basis point move at the next meeting in November on the table. In 2023, the median forecast anticipates no rate cuts, but one more 25 basis point move to 4.6%. For the year, the committee says it was evenly divided. 6 saw 4.9%, 6 saw 4.75, and 6 saw 4.5. One member put the top rate next year and this year at just 4%. So there's still a possibility we see a lot more increases in 2023. The statement, almost word for word, remained the same as the one in June. Policymakers noting they are highly attentive to inflation risks and anticipate that ongoing increases in the target rate will be appropriate. There's a wide dispersion of forecasts for 2024 and 2025. The median suggesting that the Fed funds rate falls to 3.9% in 2024 and to 2.9% in 2025. That's because inflation takes longer to fall, not reaching the Fed's target until 2025, headline and core. This year, inflation headline 5.4%, core is going to be 4.5%. Next year, headline 2.8%, and in 2024, 2.3%, core 3.1% next year, 2.3% in 2024. Now, Fed officials also bumped up their unemployment forecast to a median of 3.8% this year, 4.4% next year, and in 2024, and 4.3% in 2025. Growth takes a big hit this year. Annual GDP marked down to just 0.2% from the 1.7% they saw in June. The economy will expand 1.2% next year, 1.7% in 2024, and reaches a 1.8% potential rate in 2025. Finally, as I mentioned, almost no change to the statement, just two words in the opening sentence. Recent indicators point to modest growth in spending and production. In June, they said those had softened.
Okay, so what he's saying basically is that the Federal Reserve bumped up their interest rate expectations for the next year. And I'm going to show you the actual dot plot. So when people talk about the dot plot, you're going to know what they're talking about. I'll show you that in just a second, but listen to Jerome Powell for just a second so you understand what he's saying. They raised their interest rate expectations from the 3 to 4 range to 3.8 this year, 4.4% next. Sorry, let me turn my camera back on. 4.4% next year, and then 4.3% in 2024, I believe is what they're saying. Is that what he said? I don't know. All I know is that they're raising their interest rate expectations, that they're going to go higher for longer. All right, so let's hear what Jerome Powell had to say himself.
Nick Temeros at the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Yeah, so we're kind of in trouble. Oh wow, look. there's our Wharton professor down there. Well, that's going to go to a different screen. It's going to take me back to my browser. But we looked at a video from him last week where he was just ripping the Fed for not paying attention to the fact that a lot of the things in the CPI index are actually lagging indicators and will, even if inflation is down, they will continue to indicate higher inflation for 12 to 18 months, despite the fact that inflation is actually cooling off. And I think he's rightfully concerned about that, to be quite honest. I think there's a grave risk that the Fed simply looks at the CPI number, raises interest rates forever, and in an effort to get rents down, they're gonna have a lagging indicator with regard to owner's equivalent rent. And again, housing is about half that, which is why I was really proud to be a real estate analyst, because you can really predict what's going on with real estate stocks, because housing is about 50% almost of the CPI core number. And so I think he's rightfully concerned that the rent number is going to continue to drift higher, even if rents are going down, because owner's equivalent rent is like a big piece of that. And that's calculated on a very lagged basis. So anyway, enough about that. All right, let me get back to the slides here. Anyway, so look, I'll actually show you the dot plot. This is what the Federal Reserve said. This is like directly from their press release. So this is their median, central tendencies, and ranges. If you've done any statistics, you're going to know exactly how these little charts work, where you've got your quartiles, your quartiles here. You've got your top range, your bottom range, and the interquartiles, and your medians in the middle. It's basic statistical analysis of where all of the Fed governors think things are going. And in this case, it's a change in real GDP, gross domestic product. Now, if that turns negative, we're going to be in a recession, right? And they're predicting it's going to go from here straight down to here, which is, that's bad. We don't want that. They're not predicting a recession, because the Fed never predicts a recession. But basically, they're predicting a recession because they're usually overly optimistic about their estimates for inflation and GDP growth. If they're predicting that GDP growth is about a little between 0 and 1%, that's really bad. And if they're predicting that, then they're wrong, and it's going to be much lower, which is usually true. But then they're predicting it's going to bounce back. Now, they're also predicting that they're not going to cut interest rates by then. They're predicting that they're going to continue raising interest rates and raising interest rates through 2023 into 2024. So obviously these projections are rosy. They're wearing their rose-colored glasses, and they're wrong. So we have to be very cautious in this environment. Any stock that's very sensitive to interest rates or higher costs of capital, we have to be wary of. So they're predicting significantly lower GDP growth. And well, I mean, we're already halfway there. Look, first quarter and second quarter GDP growth were negative. Let's face it. And they're predicting basically we're staying there for a while, but things are going to pick back up, and then they're going to get a little better, and then flatten out and return to the mean of around 2%. This is always their target. I don't know why 2% is their target, but 2% is like a common target for the Federal Reserve, because they need to have a little inflation. And if you've taken my class, you know why they need to have inflation, because deflation is significantly worse than inflation. However, they need it to be small inflation, because if there's a lot of inflation, then of course we have a lot of problems, and that will shut down the economy as well. Here's their estimate of the unemployment rate. Now, as you can see, we're estimating it goes down to here, which is good, and that's about where we are. But now they're estimating it's going to go up to about 4%, flat for another year, then gradually back declining down. Okay, so I should just straight line that out. So we're around 4% at the end. So listen, if you're doing any kind of macro analysis and you're thinking about investing in consumer cyclicals, which is to say consumer discretionary stocks, handbags, luxury shoes, and vacation homes and things like that, sports cars. Look, if unemployment goes up, sales of those goods will go down. So be cautious with those. So be cautious of companies that need to raise money because the cost of capital is going to go up. Be cautious of companies that are consumer discretionary companies because if unemployment goes up, those stocks will go down. So that's why we see companies like General Mills, which are consumer staples companies, doing so well because people just keep eating and drinking. They don't stop. I don't know what it is about them. I wish they would stop doing it, but they don't. I guess they want to live, so they keep eating and drinking stuff. And then when there's inflation, companies like that, they just raise their prices. And so then they make more money. So anyway, those low growth stocks are suddenly high growth stocks. And those high growth stocks like tech, semiconductor, software, consumer luxury goods, those stocks are suddenly swirling the drain. And they're probably going to continue swirling the drain, as we can see here. So be cautious of those. Here's the PCE inflation number. They're expecting this to level off and come down. I hope they're right. We'll see. And here's the core PCE. Oh, somebody raised their hand. Go ahead. You can unmute yourself and ask a question. Go ahead. Whoever raised their hand, you can unmute yourself. You can ask a question. It's fine. Okay, too shy apparently. All right, so the Fed is expecting inflation to come back down. So hopefully that's true, and hopefully we get things under control soon. Hopefully we have a continual employment growth with inflation coming down and have a soft landing. However, it would seem that we're probably going to have a hard landing, and I think that's what the market is starting to factor in. So we'll see. Now here's the actual dot plot. The dot plot is the Federal Reserve governor's vote on where they think interest rates should be. You guys are blowing up the chat. No, somebody actually digitally raised their hand, and I got a message that somebody raised their hand, so I asked. So here's the thing. You can see the years down here at the bottom: 2022, 2023, 2024, and the Federal Reserve Board of Governors, they all vote on where the interest rate should be, right? For each year, where they think interest rates should be, and you can see the dots of their votes. That's what this dot plot is. This is an important part. Darn it. This is an important part of their press release. And so there's general consensus that in 2022, by year end, we're going to be here. Like everybody's around 4.2 to 4.3 or 4. I mean, the medians are going to be around here, which is 4.25, which is higher than it was before. And that's one of the big reasons stocks went down, because interest rate expectations went up. And for next year, they're even higher. Wow, the median's slightly higher than here, which means we're around at least 4.5. But then we see a pivot, and the median is closer to 3.75, because they're expecting interest rates to go down because they want to match inflation rates, and they expect that inflation rates will get back down around 2%. Will they be correct? I don't know. I don't know. But the thing that made the stock market so bearish is that all these expectations were so much higher than they previously were. And by the time we get here to 2025, we still have some pretty high expectations, including some outliers here. Somebody's a hardliner who's only going from here to here and not lowering their interest rate expectations. There's at least one Fed governor that thinks interest rates are going to stay high because inflation is going to stay high, and they're not going to be able to kill inflation. But by the end, by the time we get to the long run, which is like 10 years, pretty much everybody's down here in the 2% camp, right? 2 to 2.5, maybe up to 3. Not a big deal, la-di-da-di-da. Long term, they want to get it back down to here. But it's a long road. It's a long road to get from there to there. It's many years of high interest rates. And that means your discount rates on anything you do for intrinsic valuation for your stocks is going to have to be a lot higher. If you have companies that are in the tech space with no earnings, their cost of capital just went up. If you have dividend discount models in your stocks, the discount rate just went up. If you have discounted cash flow models in your stocks, your discount rate just went up. Those stocks are now worth less. Keep that in mind. And it's not just here in the US. The problem is that everybody's seeing the situation. First of all, it was just us. All right, we had inflation because we printed a lot of money to get out of COVID. But then we had wars overseas and other things, and that caused a lot of inflation worldwide. So Europe has inflation. Other countries are now raising their interest rates as well. So we've got, it's not just us, it's everybody else. Everybody's raising interest rates. The percentage of countries tightening their fiscal stance is now pretty close to 100%. Not quite, but everybody is, because we all know the ramifications of raising prices over and over again. If you get into a hyperinflationary cycle, it leads to huge problems for humanity. If you debase your currency, people starve to death. Leaders will initiate wars to blame somebody else. We cannot allow that to happen. So we have to keep the currency stable. And that means tightening interest rates, tightening our fiscal stance. And that means economic growth expectations are going to go down. And it also means that our discount rates are going to have to be higher. It's a double whammy for stocks and for bonds, for that matter. So let's just take a look at what's going on around the world. Switzerland raised interest rates 75 basis points. Hey, it's Switzerland. I would expect nothing less. UK even raised interest rates by 50 basis points. Norway raised interest rates 50 basis points. Indonesia raised the interest rates 50 basis points. Taiwan raised 1/8%. Philippines raised 0.5 point. South Africa, 0.75 point. Japan. I hate to laugh at Japan because I like Japan, but wow, they've got serious issues. They've been in a deflationary environment for so long. And so they kept their benchmark rate at minus 0.1%, which is just crazy. And Turkey, which has a hyperinflation problem, but has severe economic problems, has now cut its main interest rate by 1 percentage point to 12%, continuing its contrarian easing campaign. They are cutting interest rates while everybody's raising, even though they have hyperinflation. But they have higher interest rates to combat that inflation. So it is what it is. Every country has their own situation. Now, what you need to do when you are setting up your portfolios for your investment projects, I'll call them projects, your investment competitions, I'll call them projects. The first thing you need to do is decide which countries have the strongest growth rates, which countries have the most beneficial interest rates, which countries have the best or worst inflation rates. Do your top-down analysis. Look at the macroeconomic indicators. Decide what countries you want to invest in. Then decide in which sectors would you like to invest. Maybe food and beverage, consumer staples. Just using that as an example because this week we saw great results out of that sector. Maybe not things like tech at the moment. Maybe in a couple months when things turn around, we'll see. I don't know. But decide what countries in which you'd like to invest, and then decide in which sectors, in which industries you'd like to invest. And then within those industries, start picking stocks. Use your basic common sense. Look at things like PE ratios, growth rates, strong gross margins, low debt to equity ratios. Look for stocks that are beaten up for no apparent reason. That's the simplest thing you can do. But it starts from the top down and then go bottom up. All right. All right, so let's go on. I don't want to take up your whole night. Let's go on for a few more minutes. Are we in capitulation yet? And that's the question. And I think the answer is we're pretty close. I think the market's kind of panicking here. You can see all the times when we had a lot of put volume. And right now we're at all-time record put volume. Now you can see when we had the rebound from COVID and the meme stocks, there was so much call volume. Everybody was buying calls and nobody was buying puts. But now that's completely reversed. You can see the green, which is the call volume, is sharply lower. And the red, which is the put volume, is at an all-time high. So people are very bearish. Now, normally, if people are very bearish and nobody's bullish, that's actually a bullish sign. That means anybody who was bullish has sold and they're bearish now. They sold their position negatively, they sold short, they bought puts, whatever the case may be. But if everybody has done that, then at some point, there are no new sellers. There are no incremental sellers. We're almost there. Are we there yet? I don't know, but I think we're kind of close. Because when you see all-time record put volume, all I can see is that a lot of people are bearish and not very many people are bullish. I think what's going on is that we've had a big rotation. The bears gained a lot of people in their club because the bulls got scared and they rotated into the bear camp. So we got a lot of bears right now. But eventually what happens is you've got the long-term holders like pension funds. I don't mean the hodlers. I mean the pension funds and the mutual funds, things like that. They're going to be long-term holders. They have to be invested. Hedge funds can be short, so they don't count. And retail investors can be short, and then they'll sell, and they don't count. But they've all gone bearish. And now we see a situation where if they're all bearish, there's nobody left to get more bearish. So on balance, we're probably pretty close to the bottom, maybe another 10% down, maybe a little bit more. I don't know. Listen to what Mark Arbiter says tonight when he has his technical analysis, which comes up at 8 o'clock, by the way, because he'll have a lot to say about this. But I think, you know, we're probably getting pretty close when you see that much bearishness. Oh, here's our total put volume. And you can see with the last record where we bottomed, the market bottomed in July, and then we blew past that. We're now at new lows for this bear market. Our put volume is way up here, which is significantly higher. Everybody's buying downside protection because they think the market's going lower. It is what it is. Markets are I guess the thing that people like to say when they want you to be a good stock picker, and that I would advise you to do, is that markets are not stock markets, they're markets of stocks. And if you pick the good stocks, you will do really well over the long term. However, over the short term, markets are driven by fear and greed. And right now they're being driven by fear. And I don't think we're in an economic cycle where a lot of companies are going to go out of business. However, earnings could go lower. It's entirely possible. And maybe we see stocks go down. Now, all right, let's go on to what's going on next week. it's a quiet calendar. There's not a lot going on. Here's our economic calendar. Not a lot of big stuff. We've got consumer, well, what do we have here? Durable goods orders, okay. Ooh, that looks like it's gonna be bad. It was previously 0 and it's expected to be negative. Well, that's really bad. But if that's the expectation already, as long as it's not worse than expected, we might be okay. New home sales. All right, I'm expecting that to decline a lot because interest rates are going up dramatically. And I know a lot of people who are thinking about buying houses and they backed out. They backed out of their deals. So we had 500,000, we're down to less than 500,000 is the forecast. And then not a lot on Friday, nothing big. Personal spending. Now, if you're an analyst covering consumer stocks, you have to pay attention to this. Consumer spending and consumer confidence are the two biggest things, besides, well, maybe retail sales and personal income. All right, so those 4 things, but this is a big one. So personal spending is expected to increase 0.1%. The consensus is for a 0.2% increase. Oh, the previous was 0.1. The month over month personal income, and this is another big one, is expected to be up 0.2% versus, oh, I'm sorry, I said it wrong. Was 0.2% versus the consensus is for 0.3%. It's expected to go up. I think you can look at these in various ways. Now, if personal income was up 0.2% month over month, that's pretty hot for inflation. And if that's expected to increase to 0.3% month over month, remember, that's not year over year, that's month over month, then that means inflation is getting baked into the economy, where people are just getting raises because prices are going up, which means they're going to have more money, which means they're going to spend more, which means prices are going to go higher, and it's going to be a non-stop cycle. And that is why the Federal Reserve Bank is trying to close down inflation, because if it gets baked into the economy, where you start to have contracts like in the 1970s, where your purchase agreements had an inflationary clause and your employment contract had an inflation clause baked in, where whatever the inflation rate was, you'd get a raise by more than that amount every year. Then you can't get out of it. You have a problem where inflation gets baked into the economy and then prices just accelerate to the moon, creates incredible demand destruction, and personal spending goes up, but the number of goods sold doesn't go up. Remember? So we talked about this. So look at this. Look at these two numbers. Income is going to go up by 0.2, but spending only went up by 0.1. Now, the expectation is income goes up by 0.3, but spending only goes up by 0.2. So remember what I always say. If your parents drive to the gas station and they say, put in $20 of gas, and gas is $2 a gallon, you get 10 gallons of gas. And they keep going, and then the price went up to $4 a gallon, which it did. And they say, put in $20 of gas. Well, they're only getting 5 gallons, right? It's, you know, so it's demand destruction. The point is this: personal spending can stay solid and even increase, but the volume of goods sold can go down. It's called demand destruction. If you own a restaurant and you sell potatoes, and you go to the grocery store and you buy potatoes, and you buy 20 potatoes for $20, and the price doubles from $1 a potato to $2 a potato, and you still spend the same amount of money, $20, but you get less stuff. Now, for potatoes, it's a bad example. I should have used another example, actually, like something like widgets, for example, or whatever product. If those products come out of a factory and you're buying half as many as you used to, what happens is they lay people off at the factory. They lose their jobs. And then they buy fewer raw materials, and then the companies that supply the raw materials lay people off, and they buy fewer materials, the basic materials they use to create the whatever materials you use for your widgets, plastics or metals or whatever. It's a vicious cycle. And so we need to get inflation out of the economy, because if it causes demand destruction in terms of the volume of goods sold, it's going to create tremendous problems. All right, so, it's already quarter of, so let me wrap it up here. All right, we don't have much going on. It's quiet week. Economically, not a lot on the calendar. It's pretty quiet. Earnings-wise, Alex asks, one of the many Alexes asks, would we want to invest in Japan stocks because the negative 0.1 benchmark rate? No. The yen is going to crash, and it is crashing, versus the dollar and other currencies. Yeah, it's not going to be good for them right now. They're doing everything they can to create inflation so they can raise interest rates. Unfortunately, they're having a hard time doing it. I mean, I understand the discount rate is lower, but ultimately, yeah, you need to pay attention to the currency concerns at this point. All right, so next week, we don't have a whole lot. I mean, here's what's going on. Next week, we got Paychex and Cintas. You know, they're expected to grow. They're expected to go up. Keep your eye on these companies. This is going to help you decide where you should be investing in your industries and your sectors. Certain sectors and industries that are doing better will probably continue to do better, and all the companies in that industry and sector will do better. Look, General Mills is not a fluke. In an inflationary environment, when stocks are going down, it's not a problem investing in consumer staples companies like food, beverage, grocery stores, things like that. It's not a fluke. They just raise their prices. That's it. And you pay more, they earn more money, they have higher earnings per share, and the stocks go up. And they don't usually get a turn at the trough. They're usually the runt of the litter, right? But now is their turn at the trough. They're going to eat it up. And tech companies, semiconductor companies, companies that are economically sensitive, like communications and consumer discretionary, they're going to have a hard time right now, particularly tech companies or biotech companies that need to raise capital in the equity markets and debt markets. So be very cautious of those companies right now until things turn around. And later in the week, we have a couple of big ones. Micron Technology. Oof, I didn't even get their other earnings report here, but I'm sure this is going to be an CarMax probably, well, at least they're profitable. Well, that's not so bad. Carnival, which should be raising its rates along with the airlines, still looking negative. I don't think they'll ever get back to where they were in terms of earnings, but you never know. Hopefully this is better than expected. And then the big one, which is a Dow component, Nike. All right, this is, I think, Thursday or Friday they're reporting. So keep your eye on those. Those are the things that move the stocks, guys. Earnings, expectations of future earnings based upon the macroeconomic indicators and the news. So stay on top of it, and we'll talk about it again next week. I'll cut it off there because they only want me to go about 45 minutes, and I'm already late because it's already 48 after we only got a few more minutes. So I hope you guys tune in a few minutes to Mark Arbiter's technical indicator class, because he's going to talk about all the technical things that are going on in the market, and you'll be able to see what his take is. He's another professional. I've worked with him for a long time. And he'll give you great insights as to what's going on with like the moving averages, Bollinger Bands, and things like that. So that's it. So have a good night, guys.